Hello, everybody. Thank you all for coming. We are 60 seconds early because why not? It's Friday. So we can get through this and get you all into your weekend real fast. So this is Crypto, where I look at kind of the combination of macro and crypto to see where we are going. And the big question for me today is whether or not we have it's Friday hard or soft landing coming. And lots of really interesting signals this week from the Fed meeting, etc., and time to digest that. And yes, horrible day on the market today. Last 2 days have been hard. But let's dig into how hard and see if we're seeing a break, like a disjoint between crypto and equities, or some parallels. We'll dig into that. And only 8 days left in September. Woohoo! Can't wait for it to be gone. And this is not financial advice, just a macro tour of the world with some Bitcoin in there too. And if you want to subscribe to the channel, go ahead. Make yourself smarter. So the story anyway is the big book of today is Fed funds rates, etc. Very high still, breaking some new records all across the board. Deficits are a problem, huge impact on market and stuff. We're going to drill into all that. But first, let's look at where we are so far in the month of September. A lot of people refer to September as Rektember, at least I have been for a couple of years now. And you can see Bitcoin is still up 2.5%, 2.2%. However you want to look at it, it's not bad. It's not as catastrophic as other names. You can see big weakness in many stock names out there today and this week and so far in September. And we'll look at some charts. But people know when things fall apart, I always say Bitcoin loves a good crisis. We're beginning to see crises bubbling up all over the planet at the same time. And we'll see how that feeds into Bitcoin. But before we do that, let's look at Bitcoin. And this is from Econometrics. Cool stuff. And what they did was they analyzed the relative return of different assets. At the top, you see Apple. Then number 2 is Berkshire Hathaway. Then you got Bitcoin, Nvidia, and Tesla. And literally, Bitcoin has a return profile that is almost identical to megacap stocks. And there are so many stocks that exhibit, a market cap in the range of hundreds of billions of dollars to $1 trillion. Nvidia, about $1 trillion. Tesla, 700 billion, 800 billion. Bitcoin, 500 billion. So it's hard to believe that these names are bigger than Bitcoin, but it's very difficult to see it as an outlier asset or some exotic crypto. It literally is a ripe store of value, and it has mainstream volatility, just like Tesla or Nvidia. So I thought that was super interesting to share. And again, it's hard to believe that it's become so stable that it's like a big mega cap tech stock. So next as well, something from Swiss Bitcoin. They just flipped bullish in Bitcoin after 8 weeks being in the bearish box. So they have this analytic chart where they move around depending on a whole bunch of risk parameters. And over the last 8 weeks, we bounced around for 7 of them in the bearish box. That's the bottom pink right-hand corner. And we just breached week 38 into the bullish box. So we'll see how this goes. I do believe October could be quite good. And September has not been that bad, believe it or not, from where we are today. In addition, let's jump into what really spooked the markets this week and why, and try break it all down and try find some type of signal in the noise as we go forward. So JP spooked the markets in 2 ways. One, he said we intend to hold policy at a restrictive level until we are confident that inflation is moving down sustainably towards our objective. That's the 2% fallacy, the miraculous 2% inflation rate, which has no basis in anything. You cannot pin inflation. And the Fed are very much caught out by oil. We've been talking about oil for 2 months now, of how it could skyrocket real fast. And it did just that. I thought it would be $100 by year end. Well, we're nearly there in September, which is nuts. But the second part is kind of weird. Sufficiently restrictive only when you see it. We want to reach something that we're confident that gets us to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. So again, the Fed is being utterly consistent about this 2% fallacy, but also utterly vague about everything else. Crazy. So let's break it down. And Bombiggy is back. Good to see you, buddy. Narrative is the soft landing, but the Fed funds rate says otherwise. The white chart here, the line, is the amount of headlines, the amount of news, mainstream media pieces that talk about a soft landing. Everybody seems to be talking about, oh, everything's going to be fine, we're going to do real well. And orange is the Fed funds rate going up high. So these two simply should not be in parallel. In fact, it should be hard landing tied to the Fed funds rate. But there's more. Let's break down 3 different views of the world from everything that happened this week. And first of all, the macro status. 10-year US Treasury yield hits a 15-year high. The world's borrowing costs hit multi-decade highs. These are costs all over the world, whether in the UK or in Europe or in Australia or wherever. And the average mortgage rate in the US is above 7.5% for the first time in 23 years. And we'll also talk about how different mortgages are rolling into variable rates right now, which is going to cause a huge catastrophe in different markets. We'll focus on one in a few minutes. Second piece is the Fed status, what they think of the world. First of all, the Fed decided not to hike rates this week, which is good. But Powell did walk back his soft landing narrative. Interesting, which means he thinks maybe there's a hard landing after all the soft landing headlines that have been out and about for a long time. 3, Powell suggests neutral rate could be much higher for the US economy, which scares the living daylights of anybody trying to raise money right now. And the Fed shifts the dot plot hawkishly upwards through 2024 and 2025. And the Fed says there's no recession until 2027. I added a little clown image beside that because they are not a good barometer of what's going to happen next. They do not have a crystal ball. Nobody does. It doesn't take much to take a 1% GDP growth rate negative real fast. And for them to say that is just absolutely irresponsible, in my opinion. But what do I know? Final thing is market status. Market believes the Fed's higher for longer rhetoric all of a sudden. That's why the stock markets were so weak this week. Rate cuts. The market is now pricing at least 2, but not until mid-2024. I think it's probably going to happen sooner. Again, it needs a crisis for that to come into play. And the Fed may reconsider its stance. This is very important. If there are not enough buyers to suppress US Treasury yields and ample tax receipts to fund the government. So this is their get out of jail free card, okay? So tax receipts are in the toilet, deficits are exploding, interest on debt is rolling into variable rates for half of it. It's about $16, $17 trillion. It's just going to be an absolute poop show in a very short window of time. And this is them saying, yeah, we expect it to be a poop show, and that could force us, for many different reasons, to reduce rates. So I thought that was very, very interesting. And I'm paraphrasing. This is not verbatim. This is my interpretation of reading between the lines. Next, this is from Walter Bloomberg. Fed's Harker doubts rate cuts on the table until next year at some point. Well, that's great. But again, as I say, unless a crisis forces their hands as we go forward. In addition, let's look at some macro graphs here. The lower forever until now. If you look at this chart, focus on the red line down. That's the downline trend of lower forever. Thank you, Great Escape. But the 10-year US Treasury yield just broke out and it's going higher, and that's wreaking a lot of havoc right now. Add 300 basis points onto that at about 4.5, you get the mortgage rate of 7.5%, which is simply not sustainable in this day and age. Another view of this 10-year is mapping it to world equity yields. That is the expected return on a stock on average across all stock markets across the world. And 10-year Treasury yields are now higher than the global equity yield for the first time since 2007. And equity yields should be higher than government bond yields since equities carry greater risk. So this itself is not sustainable. This has to come down. Either equities have to perform a hell of a lot better or yields have to come down. It simply can't float otherwise. In addition, the TLT is toast. That's basically the bond market. Anybody holding bonds, they had a rough 2022. 2023 is even, not as bad, but it's still going in the same direction as 2022 and 2021 and 2020 even. It's just down. What should be the safe harbor type asset has just been losing its shirt, down from 172, 175, all the way down to 90. So it's like massive losses across this asset class. So, and just for those who know, as interest rates rise, bond values go down, and that's what we're witnessing here. So they're continue to break stuff, and I do believe more shoes will drop, more banks will fail as we go forward. Hey, Jimmy. Now, alarm bells come from Bank of America, and it's important. If you ever read, headlines or look at thumbnails of anything, there's a lot more story behind the scene, but sometimes alarmist headlines sell. So let's look at this one here. This is the Bank of America says rate worries spark biggest stock outflows this year. Global equity funds see biggest weekly outflows since December. And Hartnett sees risk of hard landing on higher for longer rates. I kind of agree with the last piece, but it's important when you break down exactly what's happening with the fund outflows. Okay, so here is the actual breakdown. The alarm bell. So global funds have had a 26 straight week of inflows at $2.5 billion, while $4.3 billion left cash funds, very important. And all the money is flowing into tech leads. All right. Everybody wants technology. Everyone wants AI. AI is the backstop for the market, and investors are rotating. They're rotating out of financials, out of healthcare, out of utilities, etc., and they're going into tech. And energy also sees the largest addition since March. And we spoke about the XLE back in July, about how that typically during the summer slumber, people rotate out of risk assets into energy. And now we're seeing the big bump in oil price, which actually pumps up energy stocks too, as well as we go forward. So that is kind of breaking down the alarm headline. If you're in disruption, like Bitcoin and disruptive stocks, like we mentioned at the beginning, everything should be just fine, of course. But you don't want those stocks to have a lot of debt, because that debt servicing cost will hurt. Now let's look at another view of Rektember for Stonks. This is not good. So what is true from Bank of America is, yes, that is the worst month since December 2022. And you can see here that the NASDAQ 100, top 100 tech stocks in the country, down 5%. And that is as bad, not as bad as December, but nearly as bad, but definitely the worst month since December. And investors are fleeing from stocks as hard landing fears grow. Okay, so what happened to the soft landing narrative? We'll see. Now, the S&P has also diverged from the job market. You can see here there's always kind of consistent correlation. Forget the March 2020 anomaly. That's a special situation. But normally, the US job openings track the S&P 500. But now, job openings are grinding to a halt, crashing down fast, whereas the S&P 500 is still strong. This divergence is concerning many people as well as we go forward. Let's look at one other chart, maybe a few more. And typically the Fed waits for things to break before they kind of start pumping a lot of money into the system and cutting rates. But the labor market is a bit of a lagging indicator, but the Fed typically stops when the labor market unwinds. And a shout out to Joe Consorti for this beautiful chart. Red is what you've got to watch. That red is going to spike up, and that will cause the blue, which is the rates, to go down. That's going to happen, but we don't know if it's the next 12 weeks or 6 months, but it will happen. All the signs are there. Now, as a kind of an early indicator, the tech industry always cuts jobs first, and the US has lost more than nearly 250,000 global tech workers have been laid off so far this year, which is kind of scary considering it's not that big a market. But I do believe that AI is a big part of this too. Now let's talk about what's happening around the world with debt and debt-laden countries. And this is an interesting chart as well from Alf Macro. And it looks at all the top rank countries where private sector debt has a percentage of GDP. Top of the list is Switzerland, followed by Sweden, followed by the Netherlands. By the way, DCA will be on Monday with 2 Swedish fellas. France, Korea, China, Canada, Japan, Australia, New Zealand, US is 153% of private sector debt as a percentage of GDP. Quite high. Greece is the lowest at 99%. But the interesting thing about this is, guess what? Switzerland stopped hiking rates and the Bank of England followed suit. And what do they have in common? Well, private sector vulnerabilities. Switzerland ranks bad on private sector debt levels and trends, and the UK also faces a huge, sizable mortgage shakeup right now that's happening. Let me pull up a quick chart from Sasha on, I won't mention what he calls this index, but it's the extent of being in trouble in the United Kingdom. And this is representative of what's happening in many markets across the world that have a lot of very short term, like 3-year fixed rate mortgages, 5-year fixed rate mortgages, etc. They are rolling off, and the UK is coming off their fixed rates, and they're almost at a peak now. Now, what happens next is it takes about 3 months for the pain to set in. So you can see you're here with that red mark at the top. But 12 weeks from now, people can handle their variable floating mortgage rate. They might be going from 2.5% to 6-7%. And they can do it because nobody's going to give up their castle and they'll struggle. But then it's going to really take a bite about 3 months later. And that could bring about a huge mortgage crisis in the United Kingdom. So be careful, everybody. They think they can scramble out and get a new fixed rate at 2.5-3%. But those days are gone, at least for a couple of years, until things settle back down to the new normal of low interest rates or almost zero interest rates. So for those in the UK with a big mortgage, be careful, make it through. Speaking of inflation that is tied to all of this, the reason they're jacking the rates is to try and control inflation. Let's check in on trueflation numbers around the world. So we now have, this always cracks me up because the US government says we have 3.7% inflation, but trueflation says 2.66%, which is much more precise, much more accurate. In fact, it's gone up a lot because of the price of oil. And this is reflected in the trueflation dashboard for the UK, for the US. Now, on the UK, the government says the inflation is 6.7%, but trueflation says it's 9.22%. Big difference. So US government is overstating inflation. Normally they understate it, by the way. And the UK government is understating it as the truth is much higher. So we are not out of the woods yet by no stretch. But however, the year-to-date low is 9% for the UK. So we're just above that. So it is coming down. And the year-to-date low for the US was 2.08%. Very close to that unicorn and rainbow fantasy number of 2% too. So they were technically there, but they don't look at the right data. So ignore that. Now, in other news as well, which is really sad, and we see this everywhere. You see businesses closing down. Pick up a newspaper, you'll hear another company hit the wall, a brand you may have known for 20, 30 years going bankrupt, boarded up windows. It's very sad, but bankruptcy filings are shooting up in recent weeks. We are now at the C19 levels and chasing up the financial crisis, global financial crisis of 2008, 2009, and here we are. However, despite all the indications of things breaking all over the place, they're still turning the screws, going after that magical 2%, which is nonsense in my opinion. Now, another piece as well, which is kind of completely nonsensical. Again, I can't wrap my head around it. US debt is growing at $18 billion a day, and that's about to shoot a lot higher. And we are not even in a crisis. So I'm thinking to myself, okay, this is just US debt. You know, there's 155 million people that have jobs that pay taxes. If you divide that 18 billion per day of new debt by 155 million, you have $116 of new debt for every worker in the US per day. Okay, you can do the math per week. You know, $850 a week, new debt per person per month. It's crazy. It is absolutely crazy when you look at it in that perspective. The people that pay the taxes to fund the government don't have a chance of ever paying enough to cover this hole. And we're not even in a crisis yet. This is the ridiculousness. So, quick conclusion, everybody. Thank you all for coming on this beautiful Friday. It's the weekend. We all need a weekend. So I do believe a hard landing is on the cards. Forget the soft landing narrative. It's just a question of when. Also, there's too much broken. The debt and deficits are just exploding way faster than I ever expected, and I was very hawkish on them to begin with. I do believe there's more shoes to drop, more bankruptcies, more banks will hit the wall, especially small regional commercial banks. They're going to get smashed. And however, that should not disrupt disruption. that's still going to chug along. We're going up to the Bitcoin halving in April, and we have a lot of companies that are changing the world very radically with the backwind of the AI revolution. So as I always stress in this channel, be in disruption. Disruption should be okay. But when people say, oh, the stock market is going to fall, yeah, it'll fall, but it's not going to hit the names that people are flowing into, as you saw from the Bank of America study. The money is still flowing into tech leaders. Although that doesn't look like that today with the weakness in some of our big names. Thank you, Stern, for being here. I love seeing people from all over the world in the chat, and I want to thank everybody in Patreon community as well. Again, thank you all for being here, and I'll see you all tomorrow where I'll recap the week so far and everything you may have missed. And once again, sorry to bring such grief tidings, such gloomy news, but it's important for us to be prepared. You don't want to go to sea and sail into a storm without knowing you're going to sail into a storm. It's better if you know the storm is coming to prepare. I'm beginning to sound like Jamie Dimon from you-know-who. He was talking about hurricanes and storms all last year, which never came to exist. I think there will be more things breaking, but it will not be cataclysmic. So thank you all. Have a great weekend. I'll see you all tomorrow. Bye.